Hello, trader friends. Welcome to episode 3 of the Trading Titans podcast. I'm here with my friend and great trader, Tom King, Uncle Tony, and today we have a great show for you guys. We're going to talk about trading, going to talk about making money, and how you can apply our knowledge to your own accounts. So, without further ado, what's what's cooking, Tom? What's new in your life?
Yeah, just trading, playing some golf. Actually, had a good golf round this week. I am renovating my lower floor of my house, so
Okay.
everything's torn up, and trying to live out of my office with a air fryer and a microwave for 2 months or something. So
Oh
that's
my goodness, that's
that's the
great.
excitement.
That's great.
Yeah, maybe.
No, why not? Hey, when you played golf, did you make any birdies? That's the most important
No
question.
birdies this week, so good number of pars, so that wasn't bad. It's an improvement.
And do you normally, when you play golf, what's your average score?
So for 18, I'm probably right around that 88 level, something around there.
So that you're pretty good.
So
So I have to come clean. I've been playing very, very little golf. I've had one round in October, and I've had one round last month. And I got invited to play La Jolla Country Club, which is
yeah,
right next to my
yeah.
home.
Mm-hmm.
So so I hadn't played since October. So the front nine, I shoot a 41, which is not bad, I think,
No,
for an
not bad at all.
old geezer like me. And then back to reality on the back nine with a 51. Well,
Golf has a way of humbling you just when you
especially
think you're great. Yeah.
especially if you didn't play for 6 months, right? So when I was younger, I was a pretty good golfer. I would say,
Mm-hmm.
single digit handicap, and
Yep.
you know, but I need to play more golf because this year I have an important golf round with my friend Tom Sosnoff. So
There you go.
I have to practice for that. Tom is a great golfer. He has a very nice smooth swing. He comes to the ball on plane, very much on plane. He hits the ball for. I mean, he has a good solid golf game, believe it or not. So
Well,
yeah.
good. Tom's not competitive at all, so he
No,
won't. He won't.
no,
Yeah, he's not going to try to. He's not going to try to beat you. At all. So
no, definitely.
I know he loves sports. And so forth. So I'm sure it should be fun. I'll tell you, So I played last week. I had a horrible week playing golf. This week I had a good week, pretty good
Yeah,
week playing golf. But
nice.
just like trading. So I spent a bunch of time in the last, I don't know, the last 2 weeks or so. I put out a bunch of videos and done a bunch with our members on consistency and the power of compounding. Which
Yep.
is the miracle of wealth building is compounding. How many income streams can you consistently keep generating money, on a consistent monthly basis, so
Right.
that it can compound over time? And I wish if I had one wish, you know, outside of world health or playing the guitar like Eddie Van Halen or any of those other things, that if I could do one thing and go back in time, I would have started investing a whole lot more, a whole lot younger, because right now I'd be sitting on hundreds of millions from compounding. But so it's the miracle of investing. But I'll tell you, consistency is the key. And
Yep.
same
Yep.
thing with the golf game. If I don't play for months or something like that, or even more frequently, it's up and down, just like trading. You can't be
Yeah.
consistent if you're not putting trades on a regular basis,
Definitely.
and trying to be consistent there. And
So I have to come clean. I stole some of your knowledge. So last week I co-hosted a week with Liz. The Liz and Jenny show,
yep. Mm-hmm.
and Liz is very kind. When Jenny's on vacation, I'm one of the chosen ones to co-host with her. You know,
Excellent.
every trader's dream to co-host a show with Liz, I guess. Who doesn't want to co-host with a very pretty,
Exactly. Yeah.
intelligent woman like her, and such a kind person too. And so I this is what I told the Tasty Trade audience, which maybe some of the people watching us already saw that show. So I stole this from you. So I told Jenny, in order to grow, everybody's asking me how can I grow a small account. So I mentioned you on the show, and so I try to come up with a set amount. So I told them, if you have an account from $0 to $25,000, you have to try to make between 1% and 3% a month on your trading, and you have to add $600 a month out of your own pocket into the account.
Hmm?
And then I came out, if it's a $50,000 account, I thought you have to add $1,000. And if it's $100,000 account, besides trying to get 1, 2, or 3% a month in trading, you have to add $2,000 a month, because I was trying to let the people know that the goal number one is to reach $200,000 so they can have portfolio margin. And it's going to take them a longer time by just compounding their trading earnings. And so I stole that from you, adding money to their account. So I hope you don't mind me stealing some of your knowledge to share with the
It's
Tasty Nation.
not just mine. So it's already out there. We're just doing what people have just done on and off. There's
Yep.
nothing. Nobody's inventing anything earth-shattering and new.
Right.
There's
Right.
tweaks to older trades, and the power of compounding has been around. It was Einstein that was saying that it was the ninth wonder of the world or something. Yeah.
It is. It is.
So
Yeah.
it's been around. We know compounding. It goes back to the Greek times. The power of compounding. So it's a key. But yeah, you gotta when you're a smaller account, you're not going to generate enough monthly income to grow that thing the way you want to. You have to contribute money. I did the same thing with my kids. I think we talked about it, but
Yep.
my daughter, I texted something in our family text chat about compounding, and I
Yep.
sent a screenshot to my kids out there. So I sent a screenshot out and let them know that if you guys just contribute $250 a month, and you just do that consistently for the next 40 years, you'll be sitting on, I think it was 170 million or something like that for the next, because they're all in their 20s. I mean, if you do it till you're 60 and you never increase it even, and you contribute $250 a month at like 20% or something a year,
Yep.
it's like 174 million or some
It's
ridiculous
crazy.
thing.
It's crazy.
They're like, well, why wouldn't you just, I don't know if that doesn't get you excited enough to want to do something. I don't know what does, but imagine what that could do for you.
Oh my God! Well, you can see it. You can see it in person. Warren Buffett. Look at his compounding in Berkshire Hathaway.
Exactly.
That's a very clear example of compounding. And one of my trading heroes, Stan Druckenmiller, he's had one of the he was able to compound, I think, almost at 30% for 20 years, and that's really unbelievable, especially trading such huge amount of money, right? To
Yeah,
be
very
able to
difficult.
compound, it's very difficult. So and also the power of negative compounding. So that's something we need to touch on, because compounding, a very big drawdown can really take away a lot of that positive compounding that you've had during the years. So what do you do personally to prevent negative compounding, Tom?
So I think the first thing that comes to mind when I talk about compounding is the fact that you have to stay consistent. You can't, instead of trading and buying options, and we're premium sellers, and that's what we do. And I think premium selling gives you a chance to be more consistent. I think as opposed to, I'm going to buy Apple and I'm going to buy leaps on Apple, or I'm going to buy stock in Apple, or I'm going to buy Apple and do this or that. When you have these weeks of, you see people on, again, YouTube or wherever, and they're posting, oh, I was up 10% this week, and then they don't post for 2 weeks, and then, or something. But you can't go up 10% one week and down 2% one week, and then up, a month for 10%, and then that. You really have to come up with those strategies that are going to be more consistent, which is why I really, for the most part, I try to avoid stocks.
Right.
Now, we do have an active trading service, and I do trade some stocks in there. But in the income navigator service that we do. And in most of my main accounts, personally, I'm trading SPY or some equivalent, ES, SPY, SPX, something like that, where it's a basket, so that that's one thing that I'm looking at, is trading an index versus trading an individual stock component to try to smooth things out. And I'm not shooting. The other thing I don't do is I'm not shooting for big gains, here, and I'm not buying and trying to get a 2 or 3 bagger or a 10 bagger or something like that. I'm not trying to double, triple, quadruple 10 bagger my money. I'm just trying to get 2% a month or 1.5% a month, or maybe even 3% in a trading account. So I think that helps me avoid those big negative months, is that I do a lot of campaign style trading, number one. And I think I do a pretty good job of keeping myself consistent keeping my buying power consistent. I think that's really what helps the most.
You touched on a very key point, and it's the progressive of a trader. When I started trading, for example, Tom Sosnoff and I have very different approaches. Tom trades all sorts of underlyings. I mean, hundreds of different products a year. I think you and me trade a little more similarly. We trade very few products, concentrating ourselves on the S&P 500, on the bonds, on some commodities, gold, Bitcoin, etc. And I've seen this as traders progress and they get tired of getting smacked with Nvidia earnings or with Google earnings, etc. With Strangles, etc., in those type of products, I think the normal evolution is to try to move away from higher volatility products like individual stocks to more. I would say I don't think it's easier to trade, but at least you don't get the huge outlier moves like you would get on an individual stock. So that's a very normal progression, and you're right that by trading those type of products, you can at least avoid a big, huge negative compounding month or a big drawdown in your account, because the S&P, it's Nvidia can go down 40%, and I wouldn't be surprised, right? It might not even break the the technical uptrend, even if it's down 40%.
It may not even hit a moving average going down that far.
Exactly. But in an index, 40%, that means the end of the world, right? And so it's the type of moves are very, very different.
A great example was last week when Salesforce reported. They had good earnings. I'm looking at it right now. Salesforce was sitting at 270. It reports good earnings, and by the next day, it's down to 220. Okay, so it loses 50 points on a 270 trade. Okay, which is a pretty good hit for good earnings. And again, this is the frustrating thing to me about stocks is. What else? I don't know what more they could have done. It's a good company. They reported good earnings, but because maybe the outlook wasn't as rosy as people wanted, or maybe they expected it to be a bigger beat, but it was still a beat.
Yeah.
And then the other frustrating thing is Adobe falls hard because Salesforce fell hard. So because Salesforce didn't do well, Adobe goes down. Okay. So that and get into stocks and talk my hatred of them all day long, but and I do have some stocks that we do trade in the active trading service, and I'll come clean. I traded AMD and Palantir this week, but I'm trading a little bit longer term horizon. And I think that's another way to try to avoid the negative a bit, is stay away from individual stocks and trade more indexes. Also, I think the fact that I have a much longer term trading horizon than most. I'm not trading 7 DTE or 14 or even much 30 DTE stuff. I don't even trade 45. I trade either 60, 90, or 120 days for the most part. So I have a lot of wiggle room. I have a lot, it's slower. Some of our people talk about watching paint dry while they're hitting all-time highs and hitting 3% every month. I don't know what's wrong with that. And they were jokingly saying it that
sure.
They've stumbled on the most boring trading plan on planet Earth, and it makes money every single month without really losing much. because it's just a little longer term horizon. It's kind of a mix between trading and investing, uh,
Yep.
a tad. Just be consistent.
I wanted to share with you something new that I have added to my arsenal. So, everybody looks at well, not everybody, fundamental analysis, technical analysis, probabilistic analysis. And I've added something else, which is the flow of funds. So, the growth of passive investing has been really through the roof in the last decade, with people investing a lot in passive indexes like the S&P 500, or every big broker like Fidelity and Schwab, they have their own version of the SPY. And because of the way those indices are weighted, I think they're weighted very unfairly.
Mhm.
A lot of the money that comes in from the 401ks every single month flows to those indices, and those indices are mainly made up of 8 stocks that we call them the Fab Five, the Fab Seven. So those stocks, I also think, are a little bit safer if we're going up than regular stocks like Salesforce, because maybe the weighting on the S&P
Mhm.
500 of Salesforce wasn't that high as an Nvidia or a Microsoft. So they're they don't benefit as much from the monthly or daily flow from 401ks, or people putting money into the stock market consistently. So individual stocks that are not a big part of the indices are even more dangerous. And so I'm looking a lot into flows, because why do stocks move and indices move? They move because there's, of course, demand for that product, right? It's all supply and demand. If the demand is big and the supply is limited, so the stock will tend to go up. Now, what people don't realize, that can work to the downside as well. If people get a little bit scared and they start liquidating their passive funds, then
Mhm.
those stocks that have a bigger weighting in the indices uh, will get hurt more than, they benefit on the way up, but they will get hurt more on the way down. So this is something that I'm watching more and more closely, is the flow of funds into the market.
Yeah, and there's so I watched some of the large investors in their portfolios. There's a couple different websites out there that track it. So when you look at not just these indexes out there, but I'm also looking at the Bill Ackmans and the Icons and the Dan Loebs and the Warren Buffett's and Berkshire and all of these people, Michael Burry, whoever. You
Of
start to
course.
add them when you look at all of these people together. The top 10 owned stocks by these guys, which are pretty much what you would expect. But I think
Right.
Microsoft is number one, Google's two, Visa is three, interestingly
Wow.
enough.
Wow.
Meta's four, Amazon's five, Berkshire Hathaway's six, then Wells Fargo, then MasterCard, then Apple. So those were the 10 most
Yeah.
most common amongst those traders. And
That's a surprising list.
yeah, so
Yeah.
I have a tendency to watch a little bit of that, and then I may dig into who do you like to walk. You've got maybe your favorites of somebody
Yep.
that invests in a style that you like, and
Yep.
um,
Yep.
I do as well. There's some traders that I really love the way they go about things,
Right.
um, and
Yeah.
I think that's what I'll look at to see what are they buying now, and what's the and is there a trade setup that I like that makes sense for me?
Of course.
I won't change my style, but what I will look at is, okay, it's an idea generator, and do it.
Definitely.
What what,
I love following macro traders like Stan Druckenmiller, like Keith McCullough, like I say George Soros. I mean, you mentioned George Soros, and they think of all sorts of crazy things. But
right?
Mr. Soros is one of the best macro traders that ever lived, and the best forex traders that ever lived. So these people are so smart. They can look at the macro analysis and then place huge bets on based on their assumptions. And on the other side, like the guys you follow, some of them are fundamental analysis, like Warren Buffett or maybe Bill Ackman, and they base their assumptions on maybe finding value, or they're bullish on the prospects of a future company. So following these type of guys and to match your trading style, I think is a very, very valuable tool, at least to get ideas into your
Right.
portfolio, right?
Yeah, just using it as an idea generator, and then I take a look and say, okay, that thing doesn't look good for what I'm trying to do. But so I don't, I don't strategy hop, for the most part. I'm pretty consistent on the strategies that I use, but I'm open to it. I mean, if you've got a strategy or somebody put the strategy out, like that's pretty interesting. It fits my
Right.
style a bit. I'll take a look at it.
Sure.
Uh, but I'm not going to, but I will run through my watch list and I will look for anything in my watch list that sets up in my styles. That's pretty much what I do every single night, every single day, is just take a quick run through. And for me, most of it's futures. So I'm running through what I call the core four or whatever, which is
Right.
ES, DB, GC, and CL. And those four, so oil, gold, bonds, and the S&P, that's it. Maybe outside of that, I'll look at maybe the Aussie dollar or something like that. But
Yeah.
that's it. Maybe 6 or 7 things, and know them pretty well. And I look at it and say, okay, based upon this, and I look mostly at the weekly charts, not the
Right.
dailies, because I'm longer term. I'm not
Right.
looking for a swing trade within the 3 or 4 days.
Of
I'm
course.
looking for a 2-3 month potential stay above my level, sell puts below it, or sell, credit spreads.
Right.
If it sets up, fine. If it doesn't, does it set up for, and then I only have a couple strategies, which is either a 1-1-2, naked puts, credit spreads, or maybe a strangle.
Right.
Okay.
So who knew Tom King is a macro trader? You just described the product that a macro trader would trade, and yay, who knew? Who knew? We're finding out new stuff in this
Yeah.
podcast.
And you got
Hey,
to adapt. You never know.
hey, now that we're talking macro, did you see the news about Australia asking Chinese companies to divest themselves from companies that trade in rare earth minerals?
No, I didn't. I did not see that.
Since you trade the Aussie dollar, I
Right.
think that's big news. Those rare earth minerals are used for many things, and one of them is defense. And it's very interesting that a country like Australia, whose number one trading partner is China, is taking negative actions against their number one trading partner, China. So
Right.
that was surprising to me. I don't know if you have the Aussie dollar in front of you, but I've not
I
checked
do.
it today. And is it doing something weird today or not really?
No, it's pretty
No?
much it's in pretty good shape. It's just been hanging right around the 21, just above the 21 EMA. It's doing fine. I don't watch a lot of news. I try to
Right.
avoid the news
Yeah.
as much as possible. I really just look at the chart. Yes, the news can move the chart, but to me, I think Tom Sosnoff, I think it
Yeah.
was him maybe a month ago, a couple weeks ago, I can't remember, was talking about the only thing you need to watch is volatility.
Yeah.
Volatility will tell you, you don't even need to look at it. He was saying, don't even look at a chart, just look at the volatility, and it will tell you what the stock is doing. If volatility is going up, most likely there's concern or news within the stock, and it's probably heading lower. If volatility is dropping, there's nothing to worry about. The news, there's no news or pending news events. I'm not to that point that I'm willing to give up looking at charts, but
Right.
for the most part, volatility and to me, a little bit of charts and a little bit of volatility watching, that replaces the news. I try to chide members who actually start posting news in the terms like, no, I don't want to hear it, because all you're going to do is you're going to get whoever was reporting the news, they're going to interview someone who's going to give their opinion on what that news means.
Right. And normally that opinion is based on their own book and
Right.
and whatever their positions are at that time, right?
Yeah.
So
I just want to look at the chart, because price is everything, and the price action tells you everything you need to know. I don't need to look at fundamental analysis. Salesforce is a great example. Okay, great
Yeah,
fundamentals, and then why did it drop 20% in one day?
yeah. It didn't meet
You
someone's
never
expectation.
know, but
Yeah,
volatility leading up to obviously to earnings is telling you that there's an impending event or some news out there that is impacting what you do. Oil's been dropping pretty substantially over the last couple of weeks, so oil's been definitely moving lower. Oil
yeah,
volatility has been moving higher. It's been putting a little bit of a crimp in my buying power because I'm heavier in oil and my buying
right.
power has been going up. And I'm at that stage where if I'm above 50% of my buying power, I shut down my new trades. So I'm kind of locking myself out of any new trades for the last week or so because the volatility in oil.
You know, you hit on a great point. All the news about oil has been bullish and should be volatility dampening. OPEC wants to keep prices up. They want to cut production, and their actions, or the news that the market is hearing, is not reflecting on the mark on the price action of the underlying. So sometimes the news doesn't match to the price action of the product. So we have to be wary about this. And something that they call MGI, market generated information. If the news is saying something and the product is going the other way, it means two things: either the market doesn't believe it, or the news is totally irrelevant, right?
Yeah. Right.
And do you watch volatility on individual stocks? Like, Apple has its own volatility index, the Nasdaq has its own volatility index, the Russell, etc. Or do you, when you're chart browsing, I don't know what you call it, do you also browse the volatility of those indices or individual products?
Not a ton. I mean, if it happens to if I pull it up on my Tasty platform and I look at the IVR in the upper left, it doesn't. I don't use volatility to make any decisions on what I'm going to trade. And somebody was posting in our service one of the VIX reading with the buying
Yep.
power recommended at Tasty, and again,
Yep.
nothing wrong with that, but it's not that I don't believe in that because at VIX between I think 12 and 15 or something, it says you should only be 25% of your
Right.
portfolio should be
Right.
invested. I would starve to death. So if I only use 25% of my portfolio, the VIX has been between 12 and 14 for like 2 years.
Right.
I wouldn't have made, for a year now, I wouldn't have made I wouldn't have made half my trades. I'd be making half of my income. So you have to, you got to be aware that, hey, with low volatility, you could increase, but it doesn't change the probability of the trade. It changes the profitability. You could,
Yeah.
when volatility is high, you can make more money, but you also have a higher chance of of losing because volatility is high. So just because volatility is over 30 doesn't mean it's a good trade. It means that it could be a more dangerous trade. You're getting
Right.
compensated for it. What I've found is that when volatility has been lower, I don't get stopped out anywhere near as much. Maybe my premium is not quite as much, but it doesn't affect the delta of the trade. It doesn't affect my win rate. Okay, all it means is that you will, when volatility is higher, I can make a little bit more money,
Yep.
and I might get out of the trade quicker if volatility reverts. But it doesn't mean that I still won't win the trade. It just means I can get out a little quicker if volatility drops, and I might make a little less money if volatility is low. But other than that, it doesn't really affect my win rate. And if I only had 25% of my buying power in the market, again, I'd starve. I'd never make any money.
I think the person who's benefiting most from this podcast is me, because I don't trade that way, and I don't try to make a set amount of money every month, and I do trade much less when volatility is low. So I'm trying to be your student, in that sense, because right now, for example, I'm very light on my positions, very very light, and you are more consistent. That's why you make more money than I do on a monthly basis. I was trained, the 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 way that if volatility is low, to have less units, And maybe that you're right. Maybe that during the years have
Yeah.
has hurt me financially, but not been able to reap the rewards because I am much less of a campaign trader than you. I'm
Right.
more of an opportunistic trader, and there
But
has
even
been
so, if you
not
have
many
less opportunity,
opportunities. There's
yeah,
no opportunities.
if you're taking less opportunities, you're going to make less money because okay, I can't trade that because volatility is low. I can't trade that because volatility is low. Meanwhile, the market's going like this, and the market
Right.
keeps going up, 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 and you could have been putting naked put after naked put or calls or selling put credit spreads or selling 111s. You could have been doing all of that stuff while the market keeps climbing. If you're
Yep.
going to wait until volatility blows up to 50% or higher, that usually means the market's going like this. Well, why would you start selling naked puts when the market's going down? Because volatility is going to be high when the market's going down. Volatility typically doesn't go up usually while the market's climbing. So if you're a put seller or a premium seller, you would have to be selling call premium. And I'll tell you what, that scares the pants off of me. So
Yep.
I can't sell. Your phrase is death before debit. Mine is death before selling a naked call ever in my life. So I will never sell naked calls
Oh,
unless extremely overbought, and maybe if volatility gets up to like 80 or 90%.
I also say never sell naked calls, but in the last 2 years, I've been selling a different type of trade. It has been my most profitable trade, and I think this is a great lead-in to our new segment. What is Tom trading, and what is Tony trading? So I have to come clean. I've been doing this trade to the upside. To the downside, we have from the most basic the naked put, then the short put vertical, then I would what I call the 1-2-0, which is put ratio, which is
Mm-hmm.
just moving the 1-1-1 up to the short strike. Then we have the 1-1-1, and then we have the 1-1-2, right? On the call side, uh, you practically only can do a short call vertical, a naked call, and a 1-2-0. Why? Because the way the call spread, the volatility skew is on the call side
Mm-hmm.
is different than on the put side. On the put side, if you go further down on the strikes of the underlying, the implied volatility of that strike keeps going up, right? That's why a Jade Lizard trade is very, very, very valuable. On uh, on the way up, it's much different. On the way up, uh, the the volatility of each strike that is further out of the money, the individual volatility goes down. And I want to show you a trade that I'm doing right now, and I have to come clean with the users. And I have had zero losses. I have had to roll it zero times, and it has made me the most amount of money so far this year. And furthermore, uh, I can add to it to protect the current trade that I am. So if you're okay with that, can I
Jump
share
in.
my screen?
Yeah, good stuff.
All righty, Tom. So you're taking a look at the top secret Uncle Tony screen. It's not that top secret, right? But I want to share one of the most profitable trades I've done this year, which is a 1-2-0 to the upside, which might scare a lot of people. I do it very, very small. On the put side, just so you know, my regular size is, for example, for a 1-2-0, I do 4-8. For a 1-1-1, I do 4-4-1, 4-4-4. And for a 1-1-2, I do 4-4-8 on SPX. So just to give you a context of how small I trade the 1-2-0s to the call side, right? So I want to I just put on this trade yesterday. Maybe I did it maybe too maybe I did it too early, right? So here it is. So what I tried to do is I normally buy, don't ask me why, I like $90, right? So when I bought the 5340 long call yesterday, it was 92 or $93. Now it's 100, right? And the minimum credit that I want to get, I'm gonna try to replicate this trade now, uh, is $15, and ideally we get closer to $20. So right now this trade is trading for 1770, which is right on my wheelhouse. I always like to buy the long call out of the money, slightly out of the money. As you can see, the $90 value is just a few strikes out of the money, right? And then the short strike, I try to get 100 points, but it's very hard when volatility has been going down. So the minimum width is 75 points. And another rule is I use T+3. So whenever I have this urge, I'm like a recovering alcoholic in regard of selling calls. So uh, in when I feel that urge to sell a naked call, I don't know if you feel the same urge as like I do, but I wait a day. And then when I feel the urge again, I wait another day. And when I feel the urge, then I wait the third day, and maybe I take action and I do this dumbass trade, which is the 1 to 0, right? And just so people playing at home understand, so this is 75 points wide. My break even for this trade would be, if we go to the short strike 54.15, we add 75, takes us to 54.90, which I think, in the next 42 days, I'm thinking it's pretty safe, right? I'm thinking it could not be, we went up a lot, and I think it's pretty much safe. So in order to make maximum profit on this trade, of course, the S&P 500 index must end up at 54.15. But what I have found out on the times I've made the most money is the indices has, for me to make a lot of money, the index has to go past my short strike, put me in the house of pain, and then maybe go back a little bit and then hit my sweet spot. It's like in golf, when you hit your shot past the pin and the ball sucks back, and it's scary to hit the ball past the pin, but when it starts sucking back, hits the green towards the pin, you feel less stress, right? So for me, in order to maximize this trade, you have to feel a little bit of pain. And first of all, I wanted to get your impression on uh, Uncle Tony coming clean selling this type of trades.
You're still selling. It's all good. At least you're quite a ways out, and you're from a margin standpoint, it works pretty well with the configuration you have. So yeah, it's a pretty good trade. From my standpoint, I would consider something like that if I felt that we were getting to a little bit of an overbought stage, on the market. So I think if the market's getting a bit overbought and a bit frothy, which it might be right now, at least on the weekly chart. Yeah, I think it's certainly an interesting setup.
And for 111 traders and 112 traders, this trade has no additional buying power, Tom.
Right.
Because it converts it into a synthetic 111 or 120 or 112 synthetic strangle. So I thought that you might find that interesting.
Right. I think what's interesting too is because you already have existing SPX positions on that are using the put side.
Right.
Span margin is calculating this to be basically a credit trade to put on.
Yeah.
So you're not even using buying power because it's really offsetting puts that you already have on. And I like to do stuff like this a little bit. And one of the things with span margin that I find really pretty interesting is because I have trades in oil and gold and bonds, sometimes when I'm putting something on ES or something like that, Now, again, you're in SPX, not using span margin, but it's still
Right.
going against um,
Right.
your trades that are on the put side. So any of those things that you can do to kind of offset or take the position. One of the things I did recently on a similar type of a note was on oil. I did a 112 trade on oil on the
Right.
put side, and I also did the call side at the same time, which created what we call a kind of a sandwich type of a trade
Okay.
that, like a strangle almost. If it stays in between,
Yeah.
we make the most money. If it goes one way or the other, you could make even more. So I
Right.
do like I like the opportunity here, and I'm a big fan of ratio spreads anyway. So I do
Yeah.
like the trade. Yeah, I think it's a
So
great trade.
for those playing at home, if you do this by yourself in your account and you don't have upsetting trades, the buying power that you correctly assume that I got a credit would probably be like an $80,000 buying power reduction just for one of these.
Right.
So, so because you nailed it correctly, that's why I said you're such a good trader. You already noticed that I'm actually improving my buying power by doing this trade. So now I want to tell the people playing at home how would I close or adjust this trade.
Hmm.
And if the market goes down fast, so here's another benefit that only the crazy people like me that do this trade know. If we have a down move tomorrow, Tom, I might already been able to take maybe $2,000 out of this. You have no idea how fast these trades pay. They can pay in almost like instant gratification. And the value when the market goes down, these trades really compress, and you can make a lot of money really fast. 2 days, 3 days, etc. Now, on if it goes against me, let's say it goes to 5,600, the S&P. So what I would do is take my $75 profit here on the vertical, put it in my pocket, similar to what you would do with the what you guys call the trap, right?
Hmm.
And I would take my trap profit and then roll the call to a further out expiration, hopefully for a credit and for a better strike in order to protect myself. So those are like the three scenarios. If it goes down, you take your profit. If it goes up a little bit, you wait and you might get a big payout. If it goes up a lot, you take your trap profit and roll the call side. And here's something that I wanted to show you, which is really, really great. Okay. So let's say this trade is in trouble, right? And what I would do is I would put another one on, Tom, that is inside my break even. Of course, right now the prices are not going to be correct because the market is not past my 54.15 strike, right? So let's move this trade down and
You can
put
look
it.
at the analyze tab, and you'll see
Yeah,
your
I'm
break
gonna
even.
put this trade in the house of pain. So I'm gonna put this 33.25, and then I'm gonna move this to the 50 52.50. Okay. So this is a typical house of pain for Tony. I put this on for a $15 credit, and now it's $58 credit, right? So I'm losing, $4,000, right? Unfortunately. So the way I would protect this trade is I would go a little bit inside and still inside my tent, and then I would look again for the $90 one, and then I would put up another one. So I would go to the 53.60, and then if we add 75 points, it would take us to the 54.35, right? I'm guessing if my math is correct. 53.60 and then 54.35. Boom. And let me sell one more. So here you have it. So if we go, let me see if we go to the analysis. If we go to the analysis, this is what happens. So I'm creating another little trap, or I call it circus tent, on top of my existing trade, right? And
Hmm.
and so look at this, how beautiful this upside thing looks. So that's a way I like to protect my my 120 to the upside. I don't know if I was able to explain it correctly on
Yeah,
my
no,
broken
no, I
on
like
my,
it. Yeah,
with my broken English. The problem with Uncle Tony's adjustment is you're adding risk to protect your current painful position, right? So I'm
yeah,
even adding an additional unit of naked calls. But because to the downside I do 4 units and to the upside I only use one, it's still I still can do four for each unit and it won't affect me,
right.
right? So I just wanted to come clean with our podcast listeners and you know and tell them what Tony's trading right now, which
Yeah,
is
I think that's a cool little trade in there, and the fact that you already got existing positions on the put side makes it essentially a free trade
yeah.
for you, unless it gets into trouble. Then,
Like and
then you got it.
I had one go into trouble last month, and it came back like that, and a winner. I have not had one losing trade like this, Tom. Not this year, well, since last year. And you know what type of bull market we've had. So
Yeah,
I'm either very lucky or I've waited enough of the up move in order to place one of these trades. So my suggestion is T+3. Whenever you feel the urge, wait 3 days.
yeah,
and
absolutely makes sense.
so that's what Tony's trading. Now I want to. Now the most important and most interesting is what is Tom trading?
All right, so a couple different things going on this week, and I'm going to stick with Strangles, which again is nothing earth shattering and maybe new, but I'll give you a sense of what I'm looking at. See if I can share my screen
Yeah, yeah,
and do that. So give me a second here. Let's see if
of course.
we can figure this thing out. All right. So hopefully you can see my screen.
Let me see. Mm, there we have it.
There we go. So you got my charts up there, and again, you don't have to see everything on it, but we'll for the most part,
There you go.
I'm looking at the weekly chart, which is the left hand pane. And I'm just looking for some
Yeah.
different setups for Strangles. Strangles have been one of my most consistent trades all year. I've had 32 Strangles and I put on, and I've won 30 of them. So
Oh wow!
uh,
Even with this huge up move, wow.
yeah, it's been good, but I've avoided putting Strangles in ES. I've been mostly oil, gold, copper, bonds, and then a couple other Strangles that are
And
out there. So I do move it around a bit, but I think I've got it dialed in a bit. It doesn't mean you can't lose. Still had 2 losers, and
and
those losers, by the way, real quick,
copper has been
yeah,
moving crazy, and no losers on copper. Wow, that's amazing.
I did have 1 loser in copper. So
Oh,
gold and
one loser.
copper were my
Okay,
2 losers back
okay,
in
okay.
March.
Yep.
Both of those were not because the price spiked up so much, but because volatility spiked up and
Right.
stopped me out.
Right.
So there's your downside of trading in a lower volatility time frame. But again, if I was waiting for these things to hit 50% or 30 IVR, I wouldn't have any trades on, and instead I have 30 winners or something now. So
And Tom, for the our viewers playing at home, when you sell one of these strangles for, let's say, $1, can you remind people, because you're very good at stopping yourself out, when would you stop yourself out when you sell this strangle for $1?
I've been taking technically like a 2x loss on it, but I've moved it to about a 1.5x loss.
Okay.
So if I sell it for $1, I want to get out when we're at 2.5.
Okay.
I've been doing it at again a 3x stop, which is a 2x loss,
Right.
which has been fine. And I like to give myself some room to work, but for the most part,
You know,
it's worked out really, really
well,
well.
that's the power of the
Uh,
strangle. I've shied away from doing strangles, but maybe because of you're being so successful, I'm gonna maybe add them back to my arsenal.
Yeah. So they've been good this year. So it doesn't
Right.
mean it's going to happen all of the time. So we're going to grab the Tasty platform. And the only reason I had Toss up here is I use Toss a little bit more for some charting.
Of course.
But I don't have any accounts. I have one account on
Yeah.
here for a couple
You know
$100.
how much it pains me to see the Toss up this. No, I'm joking with you. No,
And I
actually,
can do the same things on
I use
Tasty.
Toss also for a lot for the analyze tab and stuff like that.
It's all
Don't
I
don't
only
tell
have one
Tom.
account for a couple $100. So essentially I pay a couple $100 a year
Yep.
for the charts, and everything is that Tasty. But
You know,
uh,
you're like me. I have an account at Thinkorswim that I have $3,000 in it, and I don't touch it just to
right,
keep the. And
100%.
I bought some SPY just because I figure if I have a stock in there, they won't be able to close my account. I don't know.
Yeah, and I have I think a little bit of I think I have some SoFi or something small.
Right,
I just needed something small that I could put $150 in.
right.
And the reason is I like the charts better, and I do like the
Yeah,
fact that I have really good scans that I built over the years that I
yep,
can't really duplicate those scans.
yeah. So
So
okay, so we'll forgive you just for
yeah,
now.
so yeah, give me a little bit of a pass on this one. But if
Yep,
I'm scanning through just quickly, just trying to see what's
yep,
what's
yep.
out there, and I kind of come across, maybe like the euro, which is nice, and I also like maybe RTY. Now, both of these to me set up well for strangles. I
Yep,
like on the weekly when I'm near a 21 EMA. You don't need massive technical analysis for this. If you're
right.
close to the 21 EMA, then I'm halfway between either these are the three ATR bands or the Bollinger
Yep,
bands too.
yep.
You can use either one. And my RSI is almost right in the middle at 50. So I
Yep.
think it sets up pretty well for a trade. Let's go back and just say, okay, same
Is
thing
that
here.
is
We're
that
55.
a squeeze indicator from what's his name? What's this
It
guy?
is
John Carter?
from John Carter. So I use that again. I like momentum.
Yeah, yeah,
So I'm either trading something going up that's increasing momentum. If I want to sell puts, I want to see something that looks like this on the right side. I like to see it if
right.
it's moving up and you're above the 21 and
Yeah,
MACD is rising, RSI is rising, and if squeeze was rising or firing as well, then I'd like to sell. If I'm doing it on the weekly,
yeah,
I'd like to sell puts or ratio
yeah.
spreads.
You see, I'm a closet
Um,
technician.
and if it's in the middle,
Yeah,
okay, by the 21 and it's not doing anything like the
yeah.
euro here is and forex, then to me I think that sets up well for a strangle. So that would be my trade in here would be looking at the euro,
Yeah.
and I will go out longer. About 90 days for me is
Okay.
about the
Okay.
norm,
Yep.
and I go pretty wide. So I'm going to go somewhere around maybe 7 delta and maybe about 6 delta, 7 delta on the upside.
Yeah. Yeah. Just so people know how conservative that is, on Tasty, the brown area is the
Right,
expected move,
right.
and
I'm
then
way outside 2x the expected move.
the first dotted line is one standard deviation, and the second one is two standard deviations. So you're actually going beyond the one standard deviation.
Yep.
So that's a very, very, very conservative trade, and almost has a 90% probability, right?
Right. So yeah, you're looking at a 88% probability of profit
Yep.
in here. You're taking in 225 in extrinsic on $703 in margin.
So that's are you looking for a return on capital, or what are you looking
So
for in order?
knowing that I'm typically in these trades for about 30 days.
Right.
Okay? The average trade is 32 days when I go out to 90.
Yep.
Okay? So, which is not bad.
No.
At 45 days, you're probably looking at around 21, but at 90 days, I'm looking at about 32 days. I can wait 32 days. That way I can play golf and boat and go to the beach or do whatever I want to, and I don't have to be glued to my screen to figure out what's happening, because if I miss 2 or 3 days, most likely I'm going to be in pretty good shape. But
Right.
I'm taking in at least 25 to 30% on BP to start this trade. So this is
Okay.
30.
Okay. So that's your benchmark, like 30% return on capital. Right.
Right. So a 30% return on capital to start, and I'm going to close it at a 50% winner.
Right.
So,
So that's 15% return, probably.
yeah, so a 15% return in 30, 40 days, something along those lines.
And if you're using 50% of your overall capital, that means you're going to make, if you have all winners and you're using 50, that would make 7% profit a month, right?
Yeah. So I'm going to make, a pretty good amount. I win about 90% of these, and the
Yep.
probability of profits 88, and it works out to about I'm at 92% or something right now, but
Okay.
or 90%. So really at 90% on these, and it doesn't matter the underlying. I'm just looking for something that's not in a uptrend,
Right.
that's not strong relative strength, that's hugging the 21 EMA, and I will go wide. And even wide, I mean, I'm still taking in 30%
That's crazy.
on the
Yeah.
trade, and it's a pretty
Yeah.
tasty trade-ish
It
type
is.
of
It is.
stop. I mean, or
It
profit
is.
target, 50%.
Definitely. 50 taste.
Uh,
It's a tasty trade.
it's a
Perfectly
tasty,
acceptable. Yep.
exactly. And I was doing 2x stops. I'm moving it to 1.5 only because
Yep.
I haven't found a whole lot of. I was at 3x, and then I moved to 2x, and now I'll probably move to 1.5x right now. And you kind of just set it and forget it, and just wait and see what happens on these trades. I just closed one recently here on ES, and the last one I did. So I would like to keep one out if it sets up, which this one does. Again, brief technical analysis.
Yep.
Nothing, nothing earth shattering that anyone can't figure out. Nothing you couldn't do on the Tasty platform either, because it's just moving averages, the 3 ATR using, Wilders and the RSI, and boom, you can identify any stocks there that fit those parameters. And my last one that I stopped out on, or I
Hmm.
won on, was
Yeah.
24. It took 24 days.
Wow. Okay.
Uh, so my average strangles are really, again, about 30, 32 days on these things. I think they work out pretty well, and that's me. I'm wider. I know that's not the 45 days, and I know it's not typically at 20 or so delta. I'm quite a bit beyond that, but I'm a big chicken, and I
Yep.
just like to be conservative, and I don't want to have to watch. I also don't adjust. So I either win or I lose, and I move on.
You just went through one of the most valuable segments for people watching the podcast is you gave us your process and what's something that it's like looking behind the curtain, and thank you for sharing that, Tom. So first, you have your watch list of the stocks you trade. You went through the brief technical analysis, nothing crazy about the
Right.
underlyings. You see a product that you are interested in, you open the correct number of days out, you find a conservative trade yielding a 30% return on capital, and you set it and forget it. Hey,
Yeah.
how can that be hard, right? It's
Right.
harder to make a 2 foot putt than this. It's a
Yeah,
so
I couldn't make it. In fact, I was playing in a league, and people give me they're like, "Oh, that's good."
that's good. Good,
I don't
yeah.
think they really pay attention to the fact that I would probably miss the 1.5 foot, 2 footer anyway. That if I was playing me, I would make me putt them all out. I wouldn't give anything away, but
You know,
hopefully
I
nobody's watching from my golf group. So
I've been so used to getting putts given that when I play a tournament, I have to put those out. You
no,
realize how bad you are at putting those little ones.
it's a good strategy when you're actually match play or stroke play
Yep.
with people. Is early in the round, I give everybody their putts early in the round, and then if I'm in it and it's tight, I will make them putt it all out the second half. And now they haven't been practicing any or hitting any short putts, and now they got to make them all. So, but anyway, so there's the Strangle. This is one I want to put on, essentially now, and I'll size it up so that a typical loss for me will be less than 2% of my net X loss. Uh,
Yep.
I set them up for a 1% of my net lick for the income, because I knew that if I had a 2x loss, I would lose
Right.
2% of my net lick maximum on a trade. And I can
Right.
afford to give up 2% of my net lick on 10% of my trades being losers.
That's very gutsy. I don't know if I would be comfortable losing 2% of my me. You see, that's why everybody's different. That's why you make a lot more money than I do, right? But it's like having, if you make a lot of birdies at the beginning and you have a bogey or double bogey, it doesn't hurt you that much. The problem would be if you have that as your first trade, right, Tom? Then you might get scared.
So there's the frustrating thing with, and I know members in our service as well. They'll follow along or they'll put a trade on, and yeah, I have lost two this year. And what if you started putting them on when I did that, and you've lost two trades, and now you've lost, because you lose 1 out of 9. That 1 out of 9 can erase 3 or 4 good trades, which means
Right.
if that's one of the early ones, like you just said, oh, now I need 4 winners just to break even. But then the 5 winners beyond that. Now, I remind them that last year we called it Valmageddon, I think, in March,
Right.
and it happened
Right.
again this year in
Right.
gold. Both years it happened in gold, where gold went up and volatility spiked while gold was rising. And we lost some strangles. I lost 3 in one day last year. My rules are that I will never have more than 2 on of any one
Right.
now after that. But I lost 3 in one day. Some people lost 3 strangles in a day. Yeah, that's going to take you like 2 months to 3 months to come back from that. But some people quit doing strangle.
Yep.
I'll never do strangles again. These are
Yep.
terrible.
Yep.
Well, I ended up making another 30, 40, 50 grand the rest of the year on strangles. Had I stopped, I'd be 50 grand poorer at the end of the day. So you got to stay consistent, and you got to trade your plan, and you can't back out. You got to trade your plan, and consistency is the name of the game.
So, would you suggest people who start doing this is to say, okay, let's look at the worst case scenario that my first 2 or 3 are losers. Where is that going to put me at, right? And
Right.
and maybe make them comfortable with that loss.
Right. If it's only 2% of your account, I mean, I
Right.
get it. Even if if you have a $100,000 account and you lose 2 grand, you can come back from that, within 2 days. Not necessarily on those trades, but the market could
Right.
go up 2% in 2 days, and you're back at it with everything else that you have going on.
Wow.
And I traded a couple different strategies so that you have a assortment of things going on at all times.
Wow. I mean, this is, if I start making more money, I have to buy you a round of golf somewhere in Pebble Beach or something, because your mind works totally different than my mind. I am much more of a chicken than you are, and
And I think
I,
I'm a
I,
chicken. So it's funny.
I only risk 0.5% in a trade, half. So
Yeah.
that's how conservative I am. I'm stupid.
It's different though when you have a larger account. If you're trading PM and you're trading a $2, $3, $4 million account, my parameters are different for that than they are in a $500,000 account.
Okay.
So we can talk about that next time.
Of course. And Tom, can you remind everyone, if they want to follow your trades and follow your system, how they can find you?
All right. So on YouTube, I write down here, you can go to Tom M. King 13 on YouTube, or Tom King Trades, either one on YouTube. And if you want to check out the service that we have, you can go to Mr. Top Tick /Income Navigator, or just search Income Navigator. Or if you're on our YouTube, it's usually linked in every description. Check us out and see if it's something that something will help you. I think the great thing about it is we have a lot of smart people, and I'd like to make sure we're surrounding ourselves with a lot of really good people, not just myself or other people, all of our members constantly challenging me. Why do you do this? Why did you do that? Why do you do this? Makes you think, and it makes you a better trader. So I think you should trade with a group, trade in a group, because trading can be a lonely business if you're just sitting there by yourself all day long. Who are you going to bounce ideas off of?
You're right. Maybe you gave me one idea. Maybe the reason I'm so conservative is because I trade a big account, it's 4 or 5 accounts that I have. But maybe I'm gonna open a new $500,000 account and
That's what I do.
trade it and size it to that and then on my overall, it won't be the 2%, right?
Exactly.
But it's gonna be
that's exactly what I do.
The two
100%.
percent of this $500,000, which if the $500,000 evaporate, God has been very nice to me, been very lucky. We're still gonna eat, we're still gonna play golf, play pickleball. So you gave me, maybe that idea will help me size up. You know, like when you go to McDonald's, they say supersize it. That
Mhm.
maybe that's the way for Uncle Tony to supersize his trades
You should
and
not be, we're talking trading here too. So you should not be doing some of these strategies that you and I are talking about today if that
right.
is your life savings and you're going to
No,
retire in 4 years. So
no, no,
you've
no.
got your investments over here in a, whatever size, one,
Yes.
2, 5 million, 10 million, whatever it might be for you, for
Yep. Yep.
somebody. And then over here, you got your trading account, okay, that I'm trying to grow at a little bit faster pace. It A, keeps my mind engaged. B, I can take a little bit more risk. And if I lose 2%, okay, we still eat tomorrow and it
Right.
doesn't affect my retirement.
Right. Yeah. I don't want to go back to my OnlyFans account where to try to make a living, because I think I might go bankrupt if I
That
if I
would
go.
be that'd be great for all of us.
Thank you, Tom. So, if you want to grow your pile, follow Tom King and follow, why not, Uncle Tony. And remember, you got to risk it to get the biscuit, baby.
Have a great one.